This is the fourth part of the lecture, the macrodynamics of real estate market. We continue to answer the fundamental questions. What are the macroeconomic factors impacting the price of real estate market? Point number 2, the institutional capacity of economy to absorb external shocks. This is a key factor in giving stability to any housing market. For example, the Canadian housing market was resilient enough to absorb the shocks which happened in the year 2007 to 2008. This is mainly because of a relatively conservative mortgage system prevailing in Canada. Canada has also applied its regulation to keep the housing sector strong and healthy. Number 3, demographics and migration. In Canada and the US, the aging population of baby boomers will create more demand for residential and vacation homes in the next decade. International immigration to Canada is also an important determinant of housing market in Canada and serves as a catalyst to its growth. Number 4, technology, oil commodities boom and exports. The Canadian economic and housing activity is also affected by three external factors. Number 1, Chinese investors. Number 2, oil commodities prices. And number 3, economic activity in the US. The Western Canada is influenced by the level of Chinese and foreign investments, mainly in the mining and oil sectors. The eastern region, mainly Ontario and Quebec, is impacted by the level of exports to the US and therefore indirectly linked to the state of the US economy. Overall, the Canadian economy and Canadian dollar are strengthened by rising demand for oil and commodities. In some ways, oil commodities boom would always translate into stronger housing demand in Alberta and Western Canada. Coming to the last point 5, which is the national level of debt. In the US, the national level of debt is almost reaching about $14 trillion and will continue to grow in the years to come. Higher debt in the US is monetized by either selling bonds to China or by printing money from thin air, called as quantitative easing. In either case, it leads to greater risks and consequent higher interest rates, fast depreciating currencies, and therefore more inflation expectations. All these things translate into hyperinflation in the real estate market.